Welcome to another edition of the Pilot's Advisor, and we are very welcome and lucky to have Lee Hyder on the show, which I've gotten some feedback that people like you, Lee. They think you're funny. They think you bring a different light to the show, some experience, obviously.
Experience. You must have a color camera, and you see my gray hair when you say experience.
Yeah, well, I always record in black and white, but that's just because I don't like the way I look, and I like the black and white. But recording this podcast, actually, I'm on a cruise ship. I'm I'm a worker. You've met my wife, Carrie. Carrie likes to go on vacation, so I do what she says because that's why we're married for almost 20 years. So I'm on a cruise ship right now. We're recording this while I'm on a cruise ship, so hopefully the quality will be okay.
Now, are you bragging or are you complaining about being on a cruise ship?
Yes, both.
Yeah. Okay.
We're at sea today, so it's a good day for me to get some stuff done. But like when the seas on a cruise ship are a little rough and you can feel the ship moving.
Well, you do what everybody else does on a cruise ship and just get in line with your tray for that next buffet.
Oh, it's a fight to 300 pounds. Who's going to win?
There you go. And it's no accident. You've got your video camera pretty much from the chest up at this point. So I get it.
Thanks, Lee.
Enjoy.
Just remember, I'll see you in person later this year.
Yes, you will, for sure. Absolutely. And
right.
living color.
Yeah. Well, one of the things I wanted to talk about today, if you're up for it, is I want to talk about, I have a lot of my clients reaching out to me and they're, that the market's been crazy and, the market's doing its thing, but what it really is Howard Capital. And I wanted to talk about Howard Capital today for a multitude of reasons. Number one, I introduced you to them a few years back, and your clients have gotten to take advantage as well. And just talking a little bit about what it looks like, what it does, what a higher standard deviation does to you. But mostly, we invest for long-term gains or returns on our money so that we can retire or have income in retirement. And I mean, we talk about it all the time. The numbers don't lie. If I was just asking you to share what you want to say about Howard Capital, what would be the first thing that you'd say?
I would say that, very honestly, I'm blessed that you introduced me to the portfolio, and I know my clients are as well. As I tell people who I sit in front of and they say, well, geez, if this portfolio is so good, why are you only telling me about it now? And I tell them that, you could line up 100 different financial advisors and ask each one, what's your portfolio? What do you like? And out of the 100 advisors, you would probably get 90 different portfolios. So the world is certainly cluttered with investment choices. But again, I take my hat off to you. You are probably one of the most astute people in the industry when it comes to kind of digging out and getting bottom line details. And, when you introduced me to Howard Capital, it wasn't just, hey, look at the returns. I mean, you just had a lot of academic research to go behind what you were sharing with me. And you kind of pulled back the curtain and really introduced me to something that, honestly, for a long time, I resisted. I mean, I've been a kind of advisor that really believed in passive management, and tactical allocation was something I stayed away from. But you can't deny an over 20-year track record of a company that has produced amazing returns. So I would tell people that, if you're really just kind of chasing what I would respectfully say, which is an average return, maybe 6 or 7%, you probably don't need a financial advisor. You can probably do that on your own. But if you're really looking to, beat the market more times than not, I think you owe it to yourself to really take a hard look at Howard Capital and what they bring to the table.
Well, absolutely. And I like what you said, a long-term track record. I mean, they have a track record of over 21 years now of blowing the S&P away. I mean, I say that openly, but the numbers don't lie. And then what I really like about the fact that it's very unemotional. I mean, it's an algorithm that's been tweaked for 20 plus years, getting better and better all the time. And with technology today, if you're not being tactical, you're not taking advantage of AI, which I do think is going to play a part in trading as time goes on. If you're not doing something better that's a system to try to beat the market, then you're probably a dying breed, I would think. Because
I'm sorry.
But just like you said, I mean, if you want, I love Vanguard as a company, and we can be very, very diversified and long term and let it do its thing. But you are going to pay a low expense ratio and get very average returns. But if you're looking for something different, well.
And not only something different, but I think in today's day and age, investors need some kind of protection. You need some kind of guardrails around your portfolio to try to minimize some of these market drops. And I'm a big fan of Howard Capital's Pivotal program, which kind of, very simplistically creates stop losses in a portfolio and gives you the opportunity to kind of get out of the market, protect your previous gains, sit on the cash, and then invest back into sectors and still pick up those impressive returns, even when the market's down. So I think it's important for investors today more than ever to have a downside strategy other than just simply looking at an annuity or sitting on the sideline in cash. And I really applaud Howard Capital's, new Pivotal program.
Yeah, the pivot points are a great thing. And it just goes to show you, hey, this happened in the market. 2022 happened in the market where, the market's whipsawing back and forth. And how do you tweak something to make it better? And as you go on, you always want to, I think the Japanese call it Kaizen or something like that. It's constant improvement, right? And that's something that's very great. And yeah, exactly. The pivot points, we buy into the market and we have a stop loss on the top and the bottom. And behind that, which is not perfect, it's the buy line. And a very smart man always says, don't fight the trend. Right now, the trend is still clearly up, even though we have many people out there that know that there should probably be a correction, 5-10% correction to lock in some of these gains that we've had, and that's a sign of a healthy market when it pulls back and solidifies those gains. But until that happens, don't fight the trend. Don't fight the momentum. Take advantage of it and ride that roller coaster on the upside. And go ahead.
Yeah, and I was going to say, even though we all know that, past performance is no guarantee to the future, I think what does guarantee future, not necessarily returns, is a stylistic approach. And what Howard Capital brings to the table is not necessarily a predictable return, but they bring a predictable philosophy and strategy that just simply makes sense over the long term.
Well, and it's a system. It's an unemotional system that works. It's proven to work long term. It's getting better. And I have a lot of my clients reaching out to me right now, and they're very happy because we're blowing it out of the water. And something they don't get to see, I'm analyzing other pilots' portfolios on a day-to-day basis. It's not even close. What these other pilots are doing and these other investors are doing, you're looking at maybe 9 to 10%, and we're like pushing 24%. Okay,
right,
more than double. And on $1 million, that's a lot of money. That's 130, 140 grand in 1 year difference, and then it compounds. So right. I always argue if I can get you an extra 1 to 2% every single year, and then it compounds, that's a totally different retirement picture. So what we're doing, I'm very proud of it, and my business has grown significantly because of it. But we're trying to help people now. The other thing I talk about is pilots want all of the upside and none of the downside. Well, guess what? That doesn't exist. That's not possible. So there's a lot to be said for managing expectations as well. Do you have any philosophies on that, Lee?
Yeah, one of the things I like doing specifically with Howard Capital is showing the historical returns. And we've had some down years. And to be candid with you, I kind of like the down years from a explanation point of view to a potential client, because it shows them that, look, this is not always going to be sunshine and roses. There's going to be periods of time that we're going to have a down cycle. So again, I think it's important that a client recognizes that, these portfolios have had amazing historical returns since inception, but through those periods, you have had some down years. So when you talk about managing expectations, people need to realize that the only person who gets the portfolio's long-term return is the person who stays on the ride, even when it's going through a little bit of volatility.
Yeah, that's a great point. In 2022, everybody was losing and losing pretty big. Even if you were in a conservative portfolio that had a lot of bonds or fixed income, with interest rates going up, the whole portfolio was getting blown up and you had to stay disciplined. And I actually feel really bad because I have a couple clients that left me during that year. And if they just would have stayed, they would have got that 25% return last year. They would be up another 24% this year. And I know they didn't go to a portfolio that's doing that. And that's where being disciplined and unemotional and long-term really, really matters. And especially with a system like this where, hey, when things are good and there's some momentum in the market, we can hit the gas a little bit and get some good returns.
Yeah. And also what's exciting about the Howard portfolio is you have an opportunity to do something within it that you don't necessarily have the ability to do with other portfolios. As I'm sure, maybe some of your viewers here have seen some of the returns, which are just truly amazing. But when you have 30, 40, 50, 60% returns in a year, it gives you an opportunity to harvest some of those returns, maybe from an aggressive portfolio, move them to a more conservative portfolio. So you just don't continue to grow a portfolio, eventually having some volatility exposed to it. So I like the ability to kind of tell a client that, look, if we have a great year, I think it may make sense to harvest some of those portfolio gains, shift them to a more conservative portfolio. And that's another way to kind of protect you on the downside as well, that you can't really do if all you're doing is earning 10% on your money.
Absolutely. And when you have those kind of gains, you can see how the snowball starts working too. I mean, we talk about the old rule of 72. We can take that and divide it by whatever the return is, and that'll tell you how long it'll take for you to double your money. Well, guess what? When you have returns like this, that snowball gets built very, very fast. And I can tell you right now, 10% on $1 million is very different from 10% on $100,000. And then it compounds. And so you're really starting to see the compound effect of those things, which I find very exciting. And, I'm in this business because I wanted to be able to help people, help them leverage their money to grow and have the life that they always deserve to have. But a lot of that takes discipline that most people can't do on a day-to-day basis.
Hey, real quick break from the podcast. We want to talk to you about the Retirement Toolkit. If you have not gotten your copy yet of the toolkit, listen up closely because Ryan is going to give us the details of what's in the toolkit. You even have one on hand, Ryan, that we can show people and some of the things that are inside of it and what kind of information can people learn?
Yeah, absolutely. If you go to retirepilots.com, you can get a free retirement toolkit and we'll actually give you a free analysis of your portfolio so you can really see what's going on. But as you can see, we got some airmail here.
Nice.
That's what the toolkit looks like. Some of the things that are in there. There's a couple tax planning strategies with Zach Smith at Pilot Tax. We look at long-term records where we've got a 21-year track record of outperforming the S&P 500, GIPS certified. We can show you that. And of course, I write these with big crayons, big fat crayons for pilots. I mean, there's some Marines and Army aviators out there, but I got a couple books I've written that you're going to get to talk about retirement planning, how you should plan for your retirement, talking about taxes and tax planning,
Nice.
some other goodies, advice matters, how to let an advisor help you out, some of the data behind how much more you will have in retirement if you hire a professional. What we try to do is to try to get pilots not to speculate and gamble with their money. And I want to give you all the tools you need to not do that. Look at the data. It's completely free. We're here to help you out.
Very cool. So this is a free toolkit that you're going to get. And I don't want to gloss over that fact that you mentioned at the beginning. It also comes with a free portfolio analysis that you'll do after people get the toolkit.
Yeah, absolutely. I mean, if you have no interest in doing anything else and you just want the free materials, I'll put your name right here. We'll send it out to you. But yes, you do get a free portfolio analysis. I think most of the people, after they see the content that's in there and read the book, they want to talk to us, and we can analyze your portfolio, see if we can add any value. The numbers don't lie. I mean, we're going to find out if we can add value, and we'll get on a Zoom call with you. We'll go through it. We'll teach you. We'll show you the numbers, and I like to call that the IQ test. At some point, the numbers don't lie, and you look at it and go, "Hey, if we can help you out, and do something better, if there's a better way, well, let's help you implement that strategy."
Very good. So no obligation to work together, but you definitely get the free toolkit, great resource information. And then if you want to take next steps for that portfolio analysis, you get that as well. So a lot of great freebies there, Ryan. We appreciate you offering those to folks in the first place. I know a lot of people throughout the existence of this show have ordered them over the years, but we still got a good chunk of folks that probably are new to the show or haven't gotten their copy of the Retirement Toolkit. So be sure to get yours. Again, the way to get it is to go to retirepilots.com. That's retirepilots.com. And right there on the homepage, you're going to see an opportunity to get that toolkit. We'll also link to it directly in the description of today's episode, so look for it there as well. That's your Retirement Toolkit here on the Pilot's Advisor. Thanks, Ryan.
Well, it's hard. I can empathize with people. I mean, it's hard to be disciplined when you have your life savings in something that is experiencing volatility, but it's through our ongoing coaching and our ongoing educational process that more times than not, I believe, really helps people kind of, just stay the course. And that's really what it boils down to. I believe, I always have believed, and I always will. I mean, the equity markets, the stock market is simply the greatest wealth creation vehicle that you can find. Greater, much superior than I believe than real estate, but you've got to stay in the game to be able to achieve those returns and to be able to, accomplish what your goals and objectives are.
Yeah, and in comparison to real estate, you have much more liquidity. You have a lot more risk that's spread out. You don't have one or two or five or 10 properties. You have 30,000 different equity positions that you might have all around the world in 42 countries, and it's liquid. I mean, you have the ability to buy in and sell out anytime you want with the way the markets are.
The funny thing, I guess, if you think about the difference between the equity markets and real estate markets, you may have multiple rental properties, but just because the market, crashes like in 2008, you're not selling your rental properties at a loss. So for some reason, I think it's the ability to exit the market quickly, which plays into people's emotional hands to kind of get out of the market. And I think if it was tougher to get out of the market, people in the long term would be much better off. And, like in real estate, I mean, people who stayed the course are in great shape today. And same thing in the market. I mean, if you stay the course, history proves it out. You're going to be fine.
Well, I think that I never really thought about it that way. So basically, you're saying with real estate, the barriers to get out are so great. It's much harder to sell that property and move on versus the equity markets. And so no different than we always talk about, it's emotion. People are their own worst enemy. And so that liquidity is actually a bad thing.
And it gets even worse today when people are doing their own online financial planning. I mean, with one click of a mouse button, you can destroy your portfolio under the auspices of protecting yourself. You can't do that in real estate.
Yeah, it's a very interesting point. And I would argue that that's why you need a financial advisor talking you off that ledge, because I get it all the time where a client will come to me asking a question or trying to take a loan against their 401k. And I'm like, that's for retirement. But if you have to take a loan to go get that next toy out of your 401k plan, it might not be time to get that toy or that next airplane or boat or whatever it might be for a pilot. One other point that you brought up the point of volatility. And I know you know this, but I think it's a good conversation piece. That volatility, and of course, we all love the volatility on the upside. We don't like the volatility on the downside. But that volatility in the market is actually how we get our returns. That's how we get. And it's no different than the risk versus reward, right? You got to take some risk. You got to have your money in the market or you're not going to get any of that reward.
Yeah, it's funny, though, that people don't equate the upside return as volatility. They simply think when the market goes up, that's kind of what it's supposed to do. And when the market goes down, there's something wrong. There's something I need to adjust. I need to make a change. It is the volatility of the market is what creates the return, or else everything would stay stagnant along the way and nobody would be investing in anything.
Yeah. And I think that's a great point just to see it. And I would imagine that a lot of the emotion that's played in with a lot of investors too is just the lack of understanding on how the market works. If you don't understand something or don't understand the strategy of what we're doing, it would make it harder to sleep at night and be peacefully sleep knowing that your money was doing what it was supposed to be doing.
And it's not only that. I think today we're in an area of information overload. It wasn't long ago that you basically had a 6 o'clock and an 11 o'clock news. And you had a half an hour, and that was basically it. And you didn't know anything until the next morning or the next evening news. Today, you're getting text message alerts. You're checking your portfolio. The information, I really believe, is ultimately doing a disservice for people because it kind of creates fear. It just builds in that sense of maybe I need to do something. Maybe I need to buy more. Maybe I need to buy less. Maybe I need to get out of the market altogether. And, my advice to most of my clients, when they may be having trouble, getting on our website, looking at the website, what have you, I say, well, that's really a great thing because you know what? Don't worry about it. It's doing exactly what it needs to do. And there's nothing you can do on your computer that's going to change it.
Well, and absolutely. And if we wanted to talk about an ideal client, and I'd love you to weigh in on this, my ideal client's a guy that trusts what we're doing, maybe checks it every couple months, maybe, and goes, oh, wow, that's awesome. Things are going really great. And then we also have that client that they're on it every single day because no matter what happens, they're shooting you a text or some other comment about what's going on in the market. And I feel bad for that person. I feel bad. It's
Yeah, I
my
mean,
job. It's my job to always find a better way or a cheaper way to invest your money. And to get those returns we're looking for. That's my job as a fiduciary. But trust me with my job and go have that margarita and go live life. I feel bad for the guy that's in retirement, that's on his phone every single day, watching every little tick up and down in their portfolio. And it shows by their level of stress.
I feel worse for that client who comes into my office maybe for the first meeting with a spreadsheet longer than my conference table. And these people are tracking, I mean, literally every day, the ups and downs and trade confirmations. I mean, the whole reason you go to a financial advisor, I would hope, is that you really want to enjoy your life. You want to have time with the family, have time planning your retirement. You don't want to become a slave to your portfolio. You don't want to become a slave to any kind of newsletter or magazine. You find somebody you trust. You certainly do your homework to be sure that he or she is the right person. And you basically, I hate to use the word, but you surrender to them. Now again, there's a big difference in surrendering and just being blind. But the fact is, you don't need to be looking at your portfolio on a daily basis. I mean, to be very candid with you, I mean, there are many, many months that go by that I don't even look at my statement. I mean, I look at my mail, I see I've got my statements from Schwab, I open them up and I put them away. But I mean, it's just not what you as a single investor need to be doing with your time.
I absolutely agree with that. And I think it's important to step away. And I find those that do over the long term, because I get to see all those different clients, the ones that haven't made those mistakes, haven't made those emotional decisions, tend to have a lot more money at retirement than those that have done the speculating and the gambling and the market timing and the track record investing and all those things that we talk about.
When it goes back to expectations, and I think I've said this on many of your podcasts before, but it's really a foundational belief that I have. Look, I tell my clients from the beginning that, the market is going to do two things. It's going to create periods of fear, and it's going to create periods of jubilation where you're really excited. And we don't know which one's coming next. We don't know which one's going to last longer. But I tell them that, we live in Northeast Ohio, and during the winter months, you can look outside most of our windows and you're going to see trees that don't have a leaf on them. And to the average person, they kind of look dead. But you don't cut them down. They're simply going through a season. Now, occasionally, let's take a fruit tree. It may go through a season, and the next year, it may not produce as many apples as you would like, but you don't cut it down because it's simply a temporary thing. A year later, 2 years later, all of a sudden, the apples are riper, redder than they've ever been before. And it's the same thing with your portfolio. You don't dump a portfolio. You don't make a change just because it's down. It's going through a momentary season, and it will pass.
I think that's a great way to end our podcast. And I have a couple things to add to that because, we engineer a portfolio to handle the ups and downs of the market. That's why it's engineered the way it is. And I can't control the market. I can't control the market going up. I can't control the market going down. All I can control is your exposure to the market and your actions to make sure you don't make mistakes. And we have a individual that we listened to for a long time, and he said it the best way. He goes, I don't know if the next 20% is up or down. Nobody does. I have no clue. But I know that the next 100% is up because it always is. And I think if you follow that mentality, you're going to win. And that's what we want to do is create a bunch of winners. Lee, what else you got for us before we say goodbye? I want to get back to my vacation.
I assume the reason you're ending the podcast is not because you feel that we've given this subject everything it needs to be spoken about, but I assume as I look on the clock, it's almost lunchtime. And we all know what lunchtime on a cruise ship means. So have yourself a great day, great time with your family, and I'll look forward to maybe sharing some conversation with you in the near future.
Just remember, it's 5:00 somewhere. I'm looking for that cocktail, not the buffet.
There you go. Have a great vacation with the family.
Hey, Lee, thanks as always, and we'll see you next time.
Take care.